Good evening, Brenda Hunter, Hunter CPA. I think most of you know who I am. So we're going to start out with what everybody likes to see is the tax brackets. They were brought back to what they were. It's a favorable change for most people. And this is the dividends and long-term capital gains. So again, there is a zero bracket for each category, and then most people fall in the 15%. If you're real high income, over 518, you fall in the 20%. If you're single, 583. 20% if you're joint, but the majority of people do fall in the 15%, which is normal. They were talking, that was a big thing in the bill. They were trying to take away the 15% capital gains rate, but that didn't happen. So this was one of the issues in this bill, is that so many things were talked about and a lot of people thought they happened, but they really didn't. So that's what we're going to try to talk about tonight. Standard deduction did go up for everybody. So everybody got a higher standard deduction in 2025. The One Big Beautiful Tax Bill, anybody over 65 gets an extra $6,000. Now, obviously, like everything else, there's a limit on that. And if your income is over $75,000 for singles, $150,000 for married, it starts phasing out. You don't lose it completely. It starts phasing out. And it does phase pretty slowly. So most people get at least a portion of that. That extra $6,000. So a married couple would get $12,000. And then the rest of that is just pretty standard, where if you're over 65, you're also getting an extra amount in your standard deduction, which you were already getting. That's continued. Estates and gifts and trust. I talk about this every year, and the reason is I just want everybody to realize the tax rates for estates and trusts. If you are the trustee of an estate and trust, estates, typically you don't have an option, but in trust, you generally do when you write your trust. And for some reason, people want the simplistic way and they want to have the trust pay the tax. But if you look at these rates up here, I mean, you get up to 35% just by being over $15,000 in taxable income. So imagine to be in a 35% tax for an individual, you have to be over about $400,000. So that is why it doesn't really make a lot of sense to make the trust pay the tax. It really should be the individuals, the beneficiaries. It makes the most sense. It is kind of cumbersome sometimes when you have a lot of beneficiaries of a trust. And trust me when I say I've seen trusts that have 30 beneficiaries. It can be cumbersome, but generally those 30 beneficiaries are in a way lower tax bracket than the trust. The annual gifting exclusion did not change from 25 to 26. It's $19,000. The lifetime exemption is $13,990. And what this means is if you were to die, all your assets together, if they were worth more than that amount, you would have to pay estate tax. Most people now, if you're married, you can choose to file together in that exemption amount and double that amount. Even if one dies before the other one, you can make that election and file that election together if you think your assets are more than that amount. So a lot of people choose gifting as a way to start getting rid of some of the money that's in their possession. A couple options. One is you can gift below the $19,000. So if you're married, you can each gift $19,000 to any child, any grandchild. The other option is you can gift more than that and just file a gift tax return. So when you file a gift tax return, you're simply stating, I gifted more than $19,000 per me and my spouse. If you're single, I gifted more than $19,000. You don't pay tax on it. You don't get a deduction for it. The person you gifted it to does not pay tax on it. It's just telling the government what you did. The only thing that is a potential problem is if you're taking that money out of an IRA, keep in mind that it is taxable if you take it out. Social Security. So these are just some of the figures for Social Security. The maximum, if you are still working this year, went from $176,100 in 25 to $184,500. The earnings limit. So this number right here is if you are below retirement age, but you retire and collect Social Security, you can still work and earn this wages. Keep in mind that's earned income only. So you still can have retirement income, interest, dividends, and such. The only thing that would be limited on prior to the 67 full retirement age is earned income, other wages. So that's, wages is the only thing that would be limited. Once, at age 62, you're eligible to collect on Social Security. And at age 67, you become your full retirement age. If you wait till 70, you get your maximum amount of Social Security that you could get. Medicare rates. I get this question every single year. About 5 years ago, maybe more, they started, instead of having one Medicare rate amount for everybody in an effort to save money and cover the high cost of medical, they started charging a higher rate for Medicare. If your income was over these amounts, if 109 for individuals, 218 for marrieds, you started paying more for your Medicare than just the standard rate. So this would be Part B is regular medical, Part D is prescription. So some of the other things that came with the tax bill this year, the child tax credit went up $200 per child. If you have another dependent, or if you have a child over 17, it stayed the same at $500. This one was really confusing for a lot of people, and I know that not a lot of people have a mortgage so this is the mortgage amount, not the interest, but if your mortgage is over $750,000, you can't take the interest over that amount. So that actually happened in 2017. It was going to sunset, and they made it permanent. One of the things to mention about the One Big Beautiful bill that passed in 2025 is a lot of the things actually were similar to the 2017 Tax Cuts and Jobs Act. Those things were all going to sunset in 2025. So a lot of those got renewed. Some of them changed slightly. So you are going to see some similarities in some of those things. And this is one of them. And then another one of those is this QBI up here. So for anybody that has a small business, a little Schedule C business, even an S Corp or a partnership, a small S Corp or partnership, the first 20% of the business income was not taxable, and that was an effort to help small businesses. That also was going to sunset in 2025, and that was renewed with the One Big Beautiful tax bill. Another thing that was really good in the Big Beautiful tax bill, and a lot of people didn't even realize this was a thing, but you were limited. A lot of the reason people couldn't itemize, part of it was because they raised the standard deduction. But another reason was because they called it the SALT deduction, which a lot of people didn't even know what that meant, but it was the tax section. So in the tax section was your withholding tax, your property tax, and your licenses. Well, if some people are working, their withholding tax could be pretty high, then you add your property tax. Well, they started limiting that to $10,000. So that kept a lot of people from being able to itemize because it limited that section. So if you had a couple homes, if you had a second home, then you had withholding tax, you could easily be $20,000, $30,000, especially if two people were working on the same, return. Well, limiting it to $10,000 hurt a lot of people. Well, now they've increased that back up to $40,000. So this will help a lot of people. And they still have a higher standard deduction. A married is about $32,000. But still, if you have a bigger mortgage and you both work and have a home, more people might be able to itemize this year because of the SALT increase. So this one, a lot of people will be happy to see this, but unfortunately, just to note, it doesn't start till 2026, but we want to tell people about it so they can prepare. So one of the things is that now the charity deduction is off of the Schedule A to some degree. You can still put it on Schedule A, but you can also get an above-the-line deduction for charity. Starting in 2026, singles can get $1,000, and married people can get a $2,000 deduction. Don't have to itemize, you still get your standard deduction, but you can get up to those amounts for charity. So in 2026, you still want to save your charity. Keep in mind, this is only cash charity. It is not non-cash charity, so it has to be cash charity. But you can still do your standard deduction, get the higher amount. If you're over 65, get your $12,000 standard deduction addition, and still get the charity $1,000 or $2,000, depending if you're married or single. But that doesn't start till 2026. So save your receipts. Another thing that a lot of people are not happy about, and they were fighting this one, and it just came in the news today that it did not go through, was for anybody who's a gambler, if you won money gambling, you could take losses up to the amount you won. And that's been like that forever. For years, Michigan wouldn't let you take those losses, and about 5 years ago, Michigan got on board and started letting you, if you took the losses in the federal, you could take the losses on the state. Well, they just came through and said, starting in 2026, you can only take 90% of those winnings as losses. So I know I have a lot of gamblers who are not very happy about this. And trust me when I say I have some gamblers that have a lot of winnings, so this is going to impact a few people. And I actually have 2 professional gamblers, and they are hit by this as well. Yeah. So that's a big one. I know they're still going to keep fighting it, but. So this has been around for years. This has to do with the medical insurance. They used to call it the Obamacare, and now they call it marketplace insurance. So this has been widely argued back and forth of how they're going to fund this. It currently is still funded through people with higher income. So if your wages are single head of household above 200,000, or if you're married filing joint above 250, or estates and trusts above 15,000, you are paying an extra 3.8% to fund the marketplace health insurance. If your net investment income is above those same amounts, you're paying 3.8% extra Medicare tax. They call it Medicare tax to fund the marketplace health insurance. So currently still in place. Again, it's being widely contested right now. All right, this is new in 2025. If you buy a new car, you get to write off the interest now. So you can write up to $10,000 on a qualified car. Don't have to itemize, it's on Schedule 1. However, there's a lot of rules. It has to be domestically assembled car. That doesn't mean it has to be an American car, like what you might consider. It can be a Nissan, a Toyota, as long as it is made and assembled here in the US. That's what they mean by domestically assembled. It has to be for personal use, obviously, not business use. The loan has to be secured by the first lien on the vehicle. What that means, you can't buy it and then sell it to your daughter or son. So you have to be the first purchaser of that vehicle, and it has to be purchased in the current year. And then there's obviously an income phase out to 100 to 150 for single, 200 to 250 to married. But you can write off up to $10,000 in interest. All right. No tax on tips. So this is another one that just happened in the new bill. So you can write off, you get up to $25,000 in tips that you got in 2025, not taxable. Again, obviously there's a lot of rules on this. With the new rules, you have to have a social security number, not an ITIN. About 10 years ago, they started issuing ITINs for certain people who couldn't get social security numbers. So you have to have a social security number to get this. And also they're excluding married filing separate. I don't know why, but there's a lot of items in this new bill that exclude married filing separate. They're trying to reduce the number of people who file that way. I have no idea why. The only thing I can figure is a lot of people file married filing separate in order to not pay off their student loans. So if one person has a student loan and their income, they're paying on an income-based way, they'll file married filing separate, so the other person, their income is not considered for the student loan. I have no idea why, other than that, why they're excluding married filing separate, but that's on the next 2 slides. You cannot file married filing separate. Again, there's the income limit. It's a little higher, 150 for single, 300 for married. But this will help out restaurant workers. This one is going to be the nightmare that we have to deal with this year for tax season. No tax on overtime. The problem is they did not change the W-2s for this because overtime has historically never been on your W-2. and it didn't happen until July of 2025. So it was too late to go back and tell payroll companies they had to do this, and most payroll companies don't want to comply with this. The other big headache is at the bottom of this list. Overtime must meet federal labor standards over 40 hours. Now, anybody that's in certain unions pays over, some of them pay over 8 hours. Well, this is where the problem comes in. So if you're paid over 8 hours versus over 40 hours, technically your hours don't meet this requirement. How will we know this when we do a tax return? We won't. So this is where it's going to be a headache. So just as an example, our postal worker who does our mail at the office, she came in and said, I have over 5,000 hours of overtime, and I got a statement from the post office saying I only have 500 hours. That's, she's angry because it's different from what she thought it was going to be. And this is indicative of what we are going to see this tax season. So some of the bigger employers who pay different from the federal labor standards are giving statements or letters to their employees saying, this is what your real overtime is, or this is what your overtime should be for tax purposes. Well, these people are mad because they heard in the news, all my overtime is free and clear of tax. Now they're getting a statement or a letter saying differently, and they don't like it. So this is what the problem is going to be with this. A lot of unions, again, are fighting this. They don't like this because I don't know all the unions. I don't know how they all pay, but I know a lot of them pay. For instance, my husband owns a machine shop, and he's not union, but he does pay over 8 hours versus over 40 hours. So we do his payroll. I keep telling him I'm going to fire him, but we had to do a statement for each one telling them what their overtime was. But whether these people take that to their tax preparer, I don't know. If they take their pay stub, their final pay stub to their tax preparer, or do their own taxes, I have no idea, And that's going to be the big problem this year is people are going to use whatever documentation they want to use to prepare their tax return because it is not on their W-2s. So I don't know how this is going to work. The other thing is, people think all my overtime is free of tax, and it's only the half. So if you're paid time and a half, it's really just the half. It's the actual overtime, not the original hour. So again, people hear that and they think all my overtime is free. Yeah. So the Trump accounts, this is also new. These are accounts you can open for kids, grandkids. They have to be under 18. If they were born in 2025 or through 2028, and you open it during the year, you get an extra $1,000. You can open them for any kid under 18, but it's only the kids born in the current year that get that extra bonus $1,000. Similar in a way to the 529 plans in that anybody can contribute to it. It doesn't have to be the parent. It can be the parents, the grandparents, anybody. You open the account, anybody can contribute to it. But they have to be opened through the tax return right now. There's a form that goes on your tax return to get that extra $1,000. There's going to be a portal, but the portal doesn't start till July of 2026. But if you want to get the extra $1,000 for 2025, you got to put it on the tax return for 2025. But basically what this is it's a little different than the 529 plans in that it becomes an IRA. So you put this money in and it becomes an IRA for this child. So you can put up to $5,000 per year. It grows all the way up till they turn 18 and it becomes an IRA. When they turn 18, they can either take it and it's an IRA. If they use it for school, they have kind of the same rules as using an IRA for education. So there's no penalties if it's used for education, but it would be taxable to them because it is pre-tax money used for education, but there's no penalties. If they keep it and use it as an IRA, they can do that. They can just keep it as an IRA. So even though this has been around for years, I wanted to put this up here just to reference another option for kids, grandkids that some people do or might think of doing is the 529s plans. These have been around for a long time. Some people do them already. Some people I get a lot of questions on these. These are kind of similar in that anybody can open them. For example, I opened one for my granddaughter. I open it as the account owner. My granddaughter is the beneficiary. I can contribute to it. My daughter can contribute to it. And when my granddaughter goes to college, the money is hers. Now, I did open an MESP, which is the one through the state of Michigan. I get a deduction on my state return up to $10,000. And it's nice now because you can use it for private or secondary school in the state. And once they go to college, they can use it for anything. They can use it for example, my son had one. He got a full scholarship to college, but he could use it for room and board. If you don't use it all now, you can now roll a 529 plan into a Roth. There are a lot of rules. It is a little cumbersome, but you can do it if there's money left over, or you could roll it to another child. But they do grow tax-free while they're sitting there, and as long as they're used for education, they don't have to pay tax on this one. So that was kind of nice. My son had his for a long time, used it all for education, never paid tax on it. But the only break you do get a break on the state up to $10,000 a year by putting in these. These are the IRA and Roth amounts this year. Unfortunately, these go up like so piddly every year. I feel bad for people who don't have access to putting money in a 401k or a simple or a SEP because all people who don't have access to that can put in a $7,000 or if they're over 50, $8,000, and now it's gone up to $7,500 and $8,600. You'd think they would be, encouraging people to put more money away, but that's all they allow them to do in an IRA or a Roth. And if you have a traditional IRA, which you get a break on your taxes, it's a deduction on your taxes. A Roth is not, but it grows tax-free. That's the difference between a traditional and a Roth. The traditional, there is no income limit necessarily, but at some point it becomes non-taxable. So now you have basis in a traditional IRA. And it depends greatly on your income on your tax return. Roth, however, does have income limits, and that's what those are up here. So if you're single, it phases out between 150 and 165, and married's 236 to 246. So if you are a high income earner, what I have a lot of people do is they do what they call a backdoor Roth. You do have to have income, earned income, to do an IRA. You can't do an IRA if you don't have earned income. RMDs and qualified charitable distributions. So the RMD age is still 73. It's been 73 for a few years. In 2033, it's going to go up to 75. So apparently they think that everybody's very healthy and going to be living to longer and longer ages. If you turn 73, you are required to take RMDs out of all IRAs, SEP, simple, 401k, 403b. The only exception for that is a 401k if you are still working at 73. Then you can forego RMDs on a 401k. But that is not the case in an IRA. If you're still working, you still have to take RMDs out of an IRA. If you miss your RMD, the penalty is 25%. It used to be 50%. Right after COVID, they lowered that down to 25%. 25% of the amount you should have taken is the penalty. If you have a Roth IRA, you are not required to take RMDs. But if you leave a Roth to your children, grandchildren, they are required to take an RMD. Doesn't make sense because it's not really taxable, but I guess they don't want that money sitting there forever. So the most misunderstood rule I see is that if you inherit a traditional IRA, they changed these rules in 2020 and it was very confusing. So somebody passes away, they leave you an IRA. If it's a spouse, you may make that your own IRA. You can take ownership of it, make it your own IRA. If it's a non-spouse IRA, you have 10 years to clear that money out. However, you still, if the deceased was taking RMDs, you still have to take RMDs. I see this all the time where people do not take RMDs or think they don't have to take RMDs, they just have to clear it out in 10 years. They do have to take, you do. If the deceased was taking RMDs, you have to take RMDs. You have to clear it out in 10 years still, but you still have to take RMDs if they were taking RMDs, unless you're under 18. If you're under 18, you can wait till you're an adult. Qualified charitable distributions, it's a great option to use if you are making charitable distributions anyway. It's a great thing, do it directly from your IRAs. It comes off your adjusted gross income for everything. So just make them directly through your IRAs. The amount has went up. It was $108,000 in 2025 and it's $115,000 in 2026. So you can have money go directly to your church or to any 501c3 that you want it to. Michigan. So Michigan rate is still 4.25%, hasn't changed. Personal exemption, $5,800. New thing in 2025 is you can donate an organ, a live organ. That would the only organs you can donate live is your kidney or half of your liver. If you do that, you can take up to a $10,000 deduction on your state tax return for the costs that you incur. That would be medical costs, hotel, travel, anything like that if you donate. There's a disabled vet deduction. You do have to be 100% disabled. So I know with veterans, there are a lot of people that do qualify as partially disabled on the veterans, but you do have to be 100% disabled for veterans. Also, if you are 100% disabled on the veterans, you do get your property taxes exempt in the state of Michigan. So good thing to know if you know anybody that is exempt. You just have to fill out some paperwork and you do not have to pay property taxes in the state of Michigan. So property tax credit, those go up slightly every year. Your income limit has to be below $71,500 and your home cannot be worth more, and that's at taxable value on your property tax bill, $165,400. So sometimes one or the other one gets you, and then the max credit you would get in 2025 taxes would be $1,900. I get asked all the time about home heating credits. People are like, oh, I know I qualify for, you have to be very, very poor to get a home heating credit. So if you're single, your income has to be below $16,586. And if there's two of you, you have to be below $22,500. So it's really hard if you're collecting Social Security or have any income at all. It's really hard to get your income below those figures. Michigan pension rules. We are currently in year 4 of the 5-year. We were phasing in to have pensions not be taxable. So back in a million years ago, pensions and IRAs were not taxed in the state of Michigan. When I say not taxed, you had a very large exemption. If you can see these amounts up here, and then in 2012, they came in and said, no, too many people in Michigan because of the automotive are retiring early and we're losing all this money. So they took that away and said, single people get $20,000, married people get $40,000, and you have to be 66. So that was the rule for a lot of years. And then Governor Whitmer, when she ran in, I don't know how many years ago, she said, I'm going to bring that back. The first year, nothing happened, but then the next year they rolled out a 5-year phase-in, which has been, there was 25%, 40, 50%, 75%. So this year, so 25 is the year we're dealing with now. So each age slowly got phased in and a percent got phased in. So in 2025, this is how it works. This is the exemption, this is the full exemption amount. And these are the people born before 1946 that were always grandfathered into the old rules. These are all the other people that are slowly being brought into it. So this is how you would fit into this group. So you look for your birthday here, and everybody gets 75% this year, which is kind of nice. And then next year, everybody gets into the picture. So next year, everybody gets the amounts up here, which will slowly go up. I don't know why they don't use nice little even numbers, but they don't for some reason. The IRS doesn't either. They like to use weird numbers. But so 75% if you're married of 131, or 75, except if you were born before 1945, or 75% of 65,897. That's your exemption. And that's just IRAs and pension. Your Social Security is always free and clear of state tax. So this is just IRAs, pension, annuities. And next year you'll get the full amount. This is for me for doing taxes. We're still getting a lot of people who think that they have to ask for an invite every single year. Once you're on TaxDome in our system, you're on. It's just like a software. It's either an app on your phone or an app on your computer. You have a password, a username and password to get on. If for some reason you're not connecting, you can call Trisha and she'll reset your password, but you don't need a link every year like you used to. You can upload or download at any time. That's the beauty of it. You do have to sign an engagement letter. We do have to have an engagement letter signed to actually complete your taxes. And when we're done, we do have to have an 8879 to file your tax return. We have to have an engagement letter and 8879. It can all be done electronically now. You'd never have to step foot in our office. If you don't want to go out, you go into Florida for the winter, whatever. But you can still come in if you want. The key date, there's no weekends this year. So taxes are due April 15th. If you file an extension, October 15th. We are very short-handed this year. I lost 2 tax preparers, very sad. One retired and one young man went to work in Troy at a bigger firm. So we were unable to hire anybody. We've been trying. We did find somebody, but we're training, so we're just not in. So it's putting a lot of burden on me. So we are trying to discourage as many in-person appointments as possible to free my time up to do returns. So we are charging for appointments this year. Not a huge amount, but a small amount. Trying to prioritize advisory time for the complex people that need it. And I think that's it.
Lastly, like we always say, you don't need to worry. We're going to take care of things for you. You worry about your family. We'll worry about what's going on in the markets and with the taxes and with the estate planning. So don't worry, be happy. All right, that's pretty much it for tonight.